how do we make sense of this from the estate planning perspective? I give you my partner, none other than Caryn Keppler.
Good morning, and I want to thank Ingrid and Anthony and Hannah because this firm would be nothing without them. They are our rock. Okay, this is the time where I get to sit down with Kim and Marcus and tell them the bad news. That between the two of them, they have a $50 million estate, and they have essentially used most of their federal and New York state credit. And that is because in 2022, the federal credit is $12,920 million, $12,920,000, but is due to sunset on January 1st, 2026, and be reduced, adjusted to inflation for about $5 million. And there is no portability, although there is portability of the state and gift tax, there is no portability of GST exemption. The New York estate tax, however, is only $6.11 million for the exemption. And that means because Marcus has created a $12 million slat for Kim, he has used all of his $12 million federal exemption. And because Kim has created a $6 million slat for Marcus, she has used all of her New York state exemption. However, if Kim survives 3 years, that slat will kind of disappear into the ether because there is no clawback for gifts made within 3 years, with more than 3 years of death for New York state. Now, a question came up during someone's talk about what is the difference between a Q-tip and a slat. So I think this is a great time to address that. A slat is a spousal lifetime access trust, and it is usually a trust that is not going to qualify for the marital deduction because it is specifically being used to use unified credit. So it is not going to qualify for the marital deduction, and there are going to be other beneficiaries of that trust other than the spouse, but it is available for the spouse if need be. On the other hand, a Q-tip, which is a qualified terminal interest trust, or qualified terminal interest property, if we're going to use the full acronym, is a trust that will qualify for the marital deduction and meets certain requirements under the Internal Revenue Code. So it provides that all of the income will be paid to the spouse, and it will last for the spouse's lifetime. And the spouse could have a power of appointment over it. Now, in addition to the New York State exemption being only $6.11 million, there's also a New York.
Advance your slides to catch up.
I do. I'm sorry.
Yeah.
Okay. I'm used to having somebody else do that for me.
There's one down there. If you can see it.
Oh, okay. Thank you. In addition to the New York State exemption being only $6.11 million, there's a New York State cliff, which makes the New York estate tax even more onerous than it already is. And that is because if you're 105% over the New York State exemption, you have no exemption. So in example A, if the taxpayer has a taxable estate of $6.11 million, there's no New York estate tax. But if the taxpayer has a taxable estate of $6,415,500, the estate tax is over $500,000. So it really becomes a problem. So it's going to be really important for Kim and Marcus, who have already used part or all of their exemptions, that we're going to focus on utilizing as much of charitable exemptions as possible, as well as valuation discounts in order to reduce their estate tax liability in their planning. In addition, we have to think about the combined income taxes, which are really going to affect both their capital gains on their appreciated property, as well as their retirement accounts. For New York State residents, we have potentially combined maximum income tax rates of over 50%. And when we're talking about maximum capital gains rates, we're talking about over 38% in New York City and over 34% in New York State. And when we talk about capital gains rates, remember we're not just talking about a 20% rate on capital gains. It's 28% when we're talking about collectibles. So to the extent that they have art or other collectibles, that capital gains rate is going to be 28%. We've been looking at a period over the last 12 months where the interest rates and the AFRs have changed drastically. Last year, the short-term AFR was under 1%. It was 0.22%. It's now 4.1%. And the 75-20 rate was a little over 1%, and it's now 4.8%. Lower rates favored different kinds of planning opportunities. We were interested in looking at things like grants and sales to intentionally defective grantor trusts, private annuities, charitable lead trusts, split dollar life insurance, SLATs, those kinds of planning opportunities in low interest rate environments. When we're in a high interest rate environment or a higher interest rate environment than we've had for the past few years, we start looking at different kinds of planning opportunities. This type of interest rate environment favors Cuperts and grits and charitable remainder trusts as opposed to charitable lead trusts. So these are the kind of things that we might be looking at to favor Kim and Marcus's plans. As Bonnie and Lisa said, we have to think about dividing the assets through the divorce and how we're going to divide those assets up between Marcus and Kim in an equitable manner. We have to think about how or if we're going to unwind the slats that have already been created. We have to think about business succession and continuity planning, how we're going to get the appreciation in the business divided in an equitable manner in some way over to Kim and the succession over to Marcia. We have to create an income stream for Kim, so to support and maintain her lifestyle after she leaves the business, now that she's working at the Guggenheim. And we have to create a fair and balanced legacy for Ted and Carol, who are not involved in the business. So these are all the kinds of factors that we have to think about dealing with as we're creating this plan for Kim and Marcus. Now, when we created the Spousal Lifetime Access Trust, Kim and Marcus were allegedly happily married and planning on staying happily married. And so we used their current lifetime exemptions to do it. And we used we allocated GST exemption to those trusts as well. We removed those assets from their New York State estate tax, their New York State estates, because they were created more than 3 years ago. We We created gifted note sales, potentially to grantor trust. We created family dynasty trusts in perpetuity. With the, potentially the slats were created so that upon the death of the spouse, those trusts were created in Delaware where there is no rule against perpetuities and they could last forever for future generations. And yet they still had full control over those trusts, and they were available for each other during their lifetime. But what happens to those slats when the marriage doesn't last a lifetime? When we want to access a trust in a divorce, we have to consider certain things. Who are the beneficiaries? What are the bases that distributions can be made? Sometimes when we look at a trust in a divorce, we have to see whether or not it can be accessed for alimony or maintenance, or even inequitable distribution. We have to look at whether or not those trusts were used to maintain a lifestyle during the marriage. If they were, trust assets were used to purchase assets during the marriage that were used by the couple as marital assets. Were assets taken out of a trust to, for instance, purchase a marital home, or to take a vacation, or to buy assets that were both, buy a painting that was used, that was placed on the wall and utilized by both couples, by both members of the marriage. Is there a spendthrift provision in the trust? A provision in the trust that provides that it is not subject to the claims of creditors. In New York, all trusts are spendthrift. In certain states, all trusts are not spendthrift unless there is a specific provision in the trust. And that is indeed the case in Florida. You have to have a clause in the trust that makes it spendthrift, or it won't be a spendthrift trust. Does the beneficiary have control? Does the beneficiary have a power of withdrawal? Does the beneficiary have a co-trustee? In New York, we now have the ability to have a beneficiary serving as a sole trustee of his or her trust. And under what circumstances can a beneficiary who is a sole trustee of his or her trust make a distribution to himself? Who is the trustee? Is that trustee independent or interested? Does that trustee have an interest in the trust? Are they a potential remainderman? All of these factors go into deciding whether or not a trust that exists can be reached in a divorce settlement for potential equitable distribution or alimony or maintenance. Again, we have to consider the history. Have distributions been relied on to fund Marcus and Kim's lifestyle, or were they irregular and uneven? Does their marital property transferred into an irrevocable trust lose its character as marital property? Did they take property that was acquired during the course of the marriage and transfer it into the trust? How were those slats actually funded? With what property was used to fund those slats? Do the planning documents for this couple address what happens in the event of the divorce? Is there a definition of what a spouse is in their trust or planning documents? I often put a definition in my wills, trust, planning documents of what a spouse actually is. And it's usually takes into account not just that a divorce has actually happened, but maybe that a divorce has commenced, because the rules for a right of election are very different than the rules for the rules for a right of election are very different than the rules in a divorce. When you're in the process of getting a divorce, you still have a right of election. against the estate of your spouse. So I often put a provision in documents that says that basically makes somebody no longer a spouse as soon as an action for divorce or separation has commenced. And that will take away the right of election immediately. Can the trust be decanted? Can the trust be changed to the extent that it that can, and New York has a pretty strict decanting statute. We have, when we talk about decanting, we are basically talking about taking one trust and literally using a trust as one pitcher and pouring it into another pitcher, which is a great, way of talking about it. We're decanting into another pitcher. And we decant when we're dealing with changed circumstances. New York statute is very, very strict. We cannot decant a trust unless we have unlimited discretion to distribute principal to a beneficiary. That means, to the extent we have a HEM standard, the ability to distribute for health, education, maintenance, and support, we cannot do a decanting in New York. So we have to look very carefully at the trust instrument to see whether or not we can do that. If we have unlimited discretion, we can do it. And then decanting can be a great tool to correct mistakes in a trust, to facilitate tax benefits, to optimize a trust administration. We can limit a beneficiary's rights. We can eliminate the beneficiary, change trustees. We can change investment limitations or directions. I'm going to talk about Delaware Trust in a few minutes. Delaware, on the other hand, has a very, very liberal decanting statute. And so to a large extent, we like to utilize the law of other states in creating trusts, so that we have the ability to do more liberal decanting, as well as other advantages with state law in creating trusts. We have to look at life insurance. Kim and Marcus have life insurance policies. We assume that those life insurance policies are in irrevocable life insurance trusts. They have enough of an estate that we assume that they have seen estate planning counsel and that they have formed ILETs. And we have to think about whether or not those ILETs should be kept in place or dissolved. And I believe Lee will get to that later on. Now, with respect to Kim and Marcus's general estate plan, we will probably suggest to them that their estate plan would be in Delaware self-settled directed trusts. In general, today, we are suggesting to clients that their estate plans be held in revocable trusts with a pour-over will. Probate, even in New York, since COVID, has become absolutely impossible. In New York City, we are looking at a 6-month delay in the probate of a will. And for our clients who have estates as large as Kim and Marcus, the use of a Delaware self-directed trust is going to give them a lot more flexibility in their estate plans. They will have asset protection. They will have a lot more control. They will have much more ability for multi-generational estate tax protection, because there is no rule against perpetuities in the state of Delaware. They have much more liberal decanting rules. They can manage their own assets through the use of an LLC, underlying LLC that is owned by the trustee, and they can retain family control. So Delaware allows the fiduciary control to be split. Unlike New York, which really does not allow the fiduciary duties to be split, to be divided. Delaware will allow the duties of a fiduciary to be divided in several different ways. So in Delaware, you'll have an administrative trustee, usually a Delaware trust company, who is really just a custodian and who will be holding the LLC. And then you will have an investment direction advisor who will make investment direction decisions over the trust assets that are held in the LLC. A distribution advisor who will have the power to direct, consent to, and disapprove all discretionary distribution decisions, and a trust protector who will have the power to remove and appoint the trustee, the trust advisor, modify or amend the trust, and modify the terms of the power of appointment. So there's a lot more ability to control and a lot more discretion. In divorce, a Delaware asset protection trust generally limits the ability of an individual's creditors to reach trust assets as well. It allows the trust creator to remain a trust beneficiary, and people who can pursue claims are limited. It doesn't include a spouse if the client remarries if the client marries after creating a trust. Most assets in a Delaware asset protection trust are not going to be subject to equitable distribution in the event of a remarriage after Kim and Marcus's divorce, if they decide to remarry after the divorce. It will, however, Delaware statute is not as clear with respect to alimony and maintenance. I believe Nevada, if I'm correct. Am I correct, Lou? Nevada offers more protection.
It does.
And with respect to alimony and maintenance than Delaware does. But it will allow an independent corporate trustee broad discretion to make distributions to a class of beneficiaries. Marcus and Kim should have a trust protector over their trust. Irrevocable trusts are no longer irrevocable, especially in Delaware. The trust could actually own an interest in the family business, and there would be no interference in that family business because of the trust protector being there to avoid it. Adjustments could be made for future tax law changes. We could avoid a loss of basis step up, and the trust could always be modified in the event of divorce. Now let's talk about those slats. The slats are a problem because of two provisions of the Internal Revenue Code. The first one is Section 682, which was passed in 2018, very, very quietly around Christmas time, around New Year's. And that was the provision that made alimonies taxable income to the payor. Previously, they were deductible by the payor and taxable to the payee. So it includes alimony pursuant to a divorce or separation agreement, and because of Internal Revenue Code 677A1, slats signed and funded before January 1st, 2019. The problem with Section 682 is that unlike the rest of the Tax Cuts and Jobs Act, Section 682 is not going to sunset on January 1st, 2026. So this is a permanent provision of the code. Now, under Internal Revenue Code 677A1, A grantor is treated as the owner of any portion of a trust if the income may be distributed to the grantor or the grantor's spouse. This is, and under 672E1, which is known as the spousal unity rule, the grantor is treated as holding any power or interest held by an individual who was the grantor's spouse at the time the power or interest was created. So here's the problem. A grantor trust remains a grantor trust even after the divorce because Kim and Marcus were married when the slats were created. Now, ACTEC has been working on, there have been, the Treasury Department has introduced possible regulations, and ACTEC has been working to have those regulations changed to eliminate the spousal unity rule after a divorce. But as of now, we're still living with it. So what can we do? We can terminate the trust through the divorce, but we have a problem in this particular case. The problem is that Marcus and Kim have used their unified credits in creating their slats and they can't get it back. So what's the point? We could modify the trust in favor of other beneficiaries, but I believe that, and I think Lisa and Bonnie would agree with me, that we're going to need these slats to produce the income going back and forth, as well as to create income streams and to deal with the equitable distribution between the parties. We could think about a disclaimer, but that's going to have gift tax consequences because these trusts are more than 9 months old. We could decant them. We could use the trust as part of equitable distribution, but as Bonnie and Lisa mentioned, they're not part of the marital pot. We could equalize the trust with other assets, or we could include a tax reimbursement provision in the separation agreement, which is probably what we're going to do. I only have 10 more minutes, so I'm going to rush ahead, okay, and think about what we can do with that $10 million building. We could sell it and pay the tax, which will be about 34%. We could do a 1031 exchange. We could think about a qualified opportunity zone, or as Bonnie and Lisa suggested, we could think about a charitable remainder trust, which is perfect in this high interest environment. So we ran the numbers. There we go. And we actually have the right slide in there. We ran the numbers. If the Brooklyn building was transferred to Kim, and Kim created a charitable remainder trust, retaining a 6% annuity interest for her life, she would have a $600,000 income stream annually. She would immediately get a charitable deduction of over $3.2 million. And upon her death, whatever's left in the trust would go to charity. And since her kids, Ted and Carol, are really interested in the arts, how about creating a family foundation to support the arts that could be run by Ted and Carol? And so we could get Ted and Carol involved in something that they're interested in and run something that would create a family legacy that would interest them as well. Now, what about MK Fuel? We could think about a beat it. which is a beneficiary defective inheritors trust. A BDIT leverages the benefits of an irrevocable Delaware trust while maintaining control and access for Marcus. BDIT assets are protected from creditors and are not subject to estate or gift or generations or skipping transfer tax for future generations while the assets remain in the trust. BDIT is established by a grandparent, parent, a friend, any third party with a $5,000 gift to the trust. No other gifts are made to the BDIT after this initial contribution. The primary beneficiary would be Marcus, who's given the power to withdraw the initial $5,000 contribution. And the lapse of that power of withdrawal is going to cause the income to be taxed to Marcus for grantor trust purposes. There are unique advantages of the BDIT. Because the income is going to be taxed to Marcus, it's going to reduce his estate rather than the BDIT's assets. Marcus can utilize the assets and control the investments in the BDIT as an investment advisor, excluding any life insurance that's in there. He can control the distributions of the trust assets because he can also be the distribution advisor, as long as the distributions are limited to a HEM standard. And an independent trustee can provide continuity and full administration and support and can distribute for any other assets over and above the HEM standards. Marcus can have a limited power of appointment over the trust assets other than life insurance. And the remainder or the business assets that are in there can be left to Marcia. Marcus can sell MK Fuel to the BDIT for a promissory note, and because it is a grantor trust, the sale of the business is not a taxable event because Marcus is the grantor of the BDIT. So the BDIT is essentially creating an estate tax freeze. It's removing all the future appreciation of the business from Marcus's estate for all future generations. It doesn't require any use of GST exemption, and the business is being sold, not gifted. So we don't necessarily have valuation issues. And I think that will allow him to retain control and use of the assets. It'll give him enhanced asset protection. It will minimize his estate tax. It will protect the future growth from estate tax and creditors. The tax on all of the income will be paid by Marcus, and it will protect the MK and business from multi-generational tax, divorce, and lawsuit protection for future generations. Any questions as I rush through the end?
Caryn, one of the most startling things that as we're putting this presentation together was a slide on interest rates.
Yes.
And interest rates affect everything that we're talking about here from an estate planning perspective. Note sales, grants, all the things that you rely on the 75/20 rate for, or the note rate. And when you have the rates, 9-year notes is what we would typically have used for a sale to the BDIT, going from 1.08 to 3.97. Now you have to really carefully consider the cash flow. Is there enough cash flow inside of that BDIT trust to satisfy the debt service? And that's a real concern. We have clients right now that we're working on BDITs with, and 6 months ago when we told them they should do this, the interest rates were at 2, now they're at 4. And the cash flow is going to be challenged to satisfy the note and the debt service. And when we talk about the alphabet soup, that one slide of intentionally defective grantor trusts and spousal lifetime access trusts, once you use up your lifetime exemption, the way that you get the rest of the assets in there is by a note sale. So now you have to factor these increased interest rates in. And we want to illustrate the things that now are beneficial with interest rates still not high historically speaking, but back with a 75/20 rate of 4.8%. Now we can go back to things like qualified personal residence trusts, CUPRTs. You can put CUPRTs back on the menu. You can put the charitable remainder annuity trust, which is a wonderful tool to give someone a secure income throughout their retirements, which you couldn't use for most people because the rates were under 1.
And to sell highly appreciated assets.
And one of my old favorites, if you're in a non-immediate family situation, a GRIT,
Mm,
a grantor retained income trust, which was outlawed for the immediate family under Chapter 14,
Right.
but is available for nieces, nephews, and other non-immediate family members. Now, again, a very powerful tool, the grantor retained income trust. So as we're looking at all these things and we start talking about life insurance, and Lee's going to talk about that in a bit, we have a lot of clients that jumped into the premium finance life insurance market with adjustable rate notes. Now those notes are going to start to adjust upward, and the interest rate on that loan is going to start to really accumulate a debt that they didn't really anticipate. We have a few of those that we're working with clients on right now. How do you exit? How do you exit that kind of a strategy? All things that, because of this interest rate shift, this is seismic. We've gone 10 years.
I had a call last night on a client who has a note that is that's at like 1%, and unfortunately, it's coming from someone who is paying 4% on his brokerage account. And
Yeah.
so suddenly the person who loaned the money is taking a loss. And what can we do?
So
I mean, it's really, it's a problem.
you should be contacting your clients and talking to them about anything that they have out there with a variable rate. Because those variable rate adjustments are going to put significant strain on the plans that have been implemented. And look at ways that you might be able to work through that with some creative solutions. And Caryn talked about the Delaware Trust. We use Delaware a lot. We use Nevada as well. There are other states, South Dakota, Alaska, Tennessee now, other states that are in the competition for trust business. But you see in the fact pattern today how important flexibility in trust drafting is. And using powers of appointment, using trust protectors. And the trust protector can even be given a power to put the original grantor back on as a beneficiary. We didn't really talk about that in this case study, but you can have that power on a trust in Delaware, Nevada, and those states. New York State, unfortunately, has an antiquated trust statute. Ray Radigan's here, who is representing the Bankers Association, lobbying for an updated, improved, and greatly enhanced New York State trust statute, which has been sitting in the legislature for 6 years, 6 or 7 years, not a priority to the legislators, drafted by my former professor, Ira Bloom, but it modernizes the New York State Trust Code, and it puts in things like directed trusts and trust protectors and all the things that we have to go out of state for. So write to your state assemblyman, write to your state senator, and make them aware that the trust industry, the banking industry, the legal industry, the accounting industry would be greatly enhanced, as would New York State residents, by a modernized trust code.